We are certainly in interesting times. And one of the reasons why we're in interesting times is because we are a fund that has a very good history of outperforming the markets. And just when we happen to be at the top of our game, after just getting through a up 120% year in one of the worst years ever for the S&P 500, we are finding ourselves not outperforming the S&P 500. So I think at the very least, I owe a detailed and thorough explanation as to our current thinking and taking a look at that versus the broader market and why we may be underperforming. So I want to start with this quote from Jeff Bezos because I think this quote highlights what it is to be an investor, what is truly important for investors at the end of the day, or at least one of the things. And it's something we're going to return to. So here's the quote. It talks about profit margins and free cash flow. We're going to focus on the cash flow. It's the absolute dollar free cash flow per share that you want to maximize. And if you can do that by lowering margins, we would do that. So if you could take the free cash flow, that's something that investors can spend. Investors can't spend percent margins. Now, we're not focusing on the percent margins. I just want to reiterate what matters is free cash flow. So let's get into Microsoft and their free cash flow. And we're going to use this as a proxy for the S&P 500. They are roughly the largest player in the S&P 500. So this should give us a good understanding to some extent of how things look in the market, how things look at the top of the market, what one of the most loved positions and largest positions is looking like. And it just happens to be the case that there's a notable thing here. You're looking at a very interesting chart. And the interesting aspect of this chart is that their free cash flow is the lowest since the dot-com bubble. Now, that alone is not necessarily reason for concern. If they are experiencing tremendous growth for some reason, or expecting tremendous future growth, that is definitely not a reason for concern to have a low free cash flow yield because you're going to expect that to go up. However, my understanding is it's most likely that in this period, in the dot-com bubble, they were experiencing some form of tremendous growth. And yet, that was the beginning of a more challenging period for the stock. And I'm absolutely not saying that this is what I expect to happen. I am not making a bubble popping call here. What I'm saying is that for these reasons, I'm avoiding the stock. I'm not in this stock. I'm not saying it's a bad business. I don't think it's a bad business. I think it's a phenomenal business. I just think it's expensive. And I don't think that the free cash flow situation right now is so ideal. Now, they're growing. They're buying back the stock. It's not necessarily the worst situation, but we're going to get into things later. So I want to highlight this area, this roughly 10% free cash flow number. We're going to come back to this number later. Obviously, it goes up above that a little bit. But, you know, you look at that period, that 2012 period, that's basically the end of that flat. And then they see this, you know, large rise, similar to the last time that they went up to that 2% free cash flow. So it looks like this 10% in this particular case, this 10% was the number that pulled people back in. That was kind of the high free cash flow, you know, low multiple, low free cash flow multiple, if there is such a thing that people discuss. And then the stock went off. Earnings obviously grew, stock price grew, and the rest is history. Again, I'm not saying this is a bad stock. I'm just using it as an example that free cash flow in this case is X, and we're going to compare it to Y, DVN Energy. We're just going to use this as an energy stock that I like, and we're going to discuss some reasons why and explain why we are in this stock. We're going to look at one more, NVDA. Now, NVIDIA is obviously a phenomenal story. And I also want to say I'm not an AI expert. If you want an AI expert, you should go to Elon and the people that Elon cites and other people in the AI space to understand the fundamentals of this business and the potential growth that can come from it. I'm going to talk about my opinion on the growth that can come from it, you know, going from here, and say that this has also blown my mind a little bit. So take everything that I'm going to say about this stock with a grain of salt. But again, we are going to take a look at the free cash flow numbers, and we're going to talk about the science and the art, and it's going to be very rough here. So NVIDIA is also low on its free cash flow numbers. But if you remember last year, right around here, right around this first earnings that was really the first big earnings in the post-ChatGPT era, you'll remember after the earnings, people were saying the multiple went down after that earnings. And that was true. And the free cash flow yield went up. It was roughly 0.5 or so, thereabouts, right here. It was May 24, 2023, 0.7, 0.7-ish. And it actually did end up going down. So, or the multiple ended up going down, free cash flow went up, but it's still quite low. It's almost half of Microsoft's free cash flow. But it's growing tremendously. So again, that alone is not reason for concern. Obviously, that 0.5 was not reason for concern because it experienced such tremendous growth. You know, if you grow, if you buy back shares, yeah, today's low number is not going to be so bad. But let's start, let's start looking at things. Let's try to look at it from a different angle here. So you've got $15 billion last quarter's free cash flow. And obviously you can experience growth on top of that. But just for the sake of a case I'm trying to bring, we're gonna leave it at that and annualize that. So $3.25 trillion is the market cap. 15 billion was last quarter's. We're going to annualize that for the estimates I actually saw earnings coming down for next quarter, free cash flow going up slightly next year. But this is a very hard to predict stock. Many people have been very much shocked by it, so I don't know how much I want to trust estimates. But we're just going to go right here and look at this. 54 years to break even on a cash flow basis, assuming no share buybacks. Obviously, they're going to buy back the stock. Obviously, they're going to buy back some of the stock. What are they going to do with all that cash? They've got like 67% operating margins. They're going to buy back some stock. But so is DVN Energy. And we're going to discuss how this number compares to the DVN Energy number. And we just got to bring it back to what matters to investors is free cash flow. That's just what matters. So now I'm going to discuss I'm just going to bring in some slight AI skepticism here because there's not a lot of it, it seems, but I'm a little skeptical on NVIDIA's growth rate continuing and them, for example, 5xing their free cash flow when they already have 69% margins. Now, if the stock gets bought back, they could do something crazy like that, or, per share, free cash flow per share, which is what's also in the quote. But you already have all the biggest companies in the world basically going hand over fist, paying tremendous prices for NVIDIA's product. They have a lot of it. And, NVIDIA had like some 50% downdraft in earnings just in 2022 because a similar situation happened when, remember, there was that whole chip shortage. Remember hearing about the chip shortage in 2021? Yeah, it can happen. I'm not saying it's going to happen. I don't know. I'm not a computer scientist like this. I don't know. I have no idea. But, my investor mind, I'm an investor. I can look at these things at a big picture level, says that's very much a possibility. So when all these companies are already spending remember Meta was down like 20% or something on earnings because they said they were going to spend so much. They're going to spend even more? They're going to take even more money? There's no more, they're going to spend all their profits on NVIDIA chips again? Maybe. I'm just skeptical about it. And I'm trying to find what's the next thing around the corner. What's the next level to this AI that's going to really, continue the investment? It's replacing labor. So I go to UiPath. 8th largest position in ARKK. This company's been doing this for a while. I remember hearing about this a long time ago. I've been looking at this stock. I've been following the stock. I might take a position at some point. The numbers aren't bad, but the stock's at all-time lows. This is not a stock that is declining. These numbers are going up. Okay? And this stock, this company, is actually doing things for enterprise. So this is not ChatGPT. I love ChatGPT. I use the product all the time. But they're actually trying to replace labor. That's what they're trying to do. Do all these kinds of things. I mean, this is like the quintessential AI stock. It's at all-time lows. And this is a real company, 8th largest position in ARKK. So that is what's leading. This is the bulk. These two stocks right here are over $6 trillion in market cap, huge percent of the S&P 500. These are the companies that are winning. These are the year-to-date winners. These are the one-year winners. These are the winners. These are the stocks that if you had them, you are at the opposite end of us, essentially. We are towards the bottom of the pile right now, even though we didn't used to be. And, we were in the opposite position in 2022. Now we're in the opposite position now. And these are the ones that are at the top. So now let's go and take a look at what we're buying and why we're buying it. So this is DVN Energy. Just for the sake of fairness, we're going to pull up the all-time. And you can see, there's definitely a lot of time when this stock is negative free cash flow. And I point particular to this 2014 period when oil was at all-time highs. And that's particularly notable because if you look at real all-time highs, inflation-adjusted all-time highs, it's even more so. And yet this company was negative free cash flow. However, the stock was quite strong then. And the stock was quite strong around here when they were negative because they were investing so much. They were growing so much. They were very much in growth mode. Now we're at this 10% or thereabouts. Now we're going to bring it up to the 5-year. 10% or thereabouts number. And we are hanging in here quite well. We're staying in here quite consistent. I don't know exactly what happened here. This was some investment or something. And the way I'm looking at the transition from this volatile, lots of negative, to this post-COVID, pretty consistent positive cash flow, well above those other stocks, healthy, lots of share buybacks also, is that we are now reaping the rewards of all that investment. If you listen to the commentary of this business, they're trying to be very capital disciplined. That's a phrase you'll hear on a lot of these earnings calls. Capital discipline, capital discipline. And capital discipline means higher free cash flow, means more buybacks. So what I'm personally expecting is for this number to continue to inflect up as that share count gets reduced. And either inflect up if the stock continues to go absolutely nowhere, even though, in April or from February to April, it went from the lows of the year to the highs of the year. The stock has essentially done nothing, has essentially stayed flat. If the stock stays flat, I expect this number to go up, but this number could stay the same if the stock begins to increase and this free cash flow yield goes down. And that would be fine because that's 10% free cash flow. So they're just going to essentially cannibalize the entire company. Charlie Munger says he likes his cannibals. Now here's the thing. Let's say the stocks stay flat and we actually have to see fundamental improvements in the business or something thereabouts. Let's just say no share buybacks, although this company is just hoarding shares and, the shares stay flat. You have to more than 5x this number in NVIDIA to equal this number, the free cash flow. And we bring it back to this quote. You have to 5x, more than 5x this number to equal this number. So that is the crux of the situation. But there's a very good potential reason for this. Obviously, oil prices are volatile. We'll talk about that when we get to this slide. But there's also the notion, the bigger notion, more important notion, that oil consumption is going away. It's going away. Well, what do you think the EV adoption rate in the United States, with our incentives, with our Inflation Reduction Act, was in 2023? 7.6% of new car sales were electric vehicles. Now, Elon Musk himself on the Joe Rogan podcast said, you need, even if we had 100% adoption of new car sales and EVs, 20 years to phase out all the oil cars in the United States. Why? Because the average lifespan of a car on the road is 20 years, and that number is actually going up. So you only got 7.6. And a lot of people are expecting 2030 peak oil. Now, that's a number I don't agree with, and we're going to take a look at why. Now, we have to consider a lot of this is hard to know. This is really art and science meet We don't know any of this with certainty at all. Like nobody knows. Nobody's going to bat 1,000. This is like baseball, right? So what we do know is the 20 years thereabouts to replace all gasoline cars on the road. We know 7.6% in 2023. And we have these people, CEO of Occidental, this is Warren Buffett's company, saying, 2025 onwards, we're going to have trouble. And it just so happens that seems to be what JP Morgan is saying. You've got this, and this is a pretty conservative demand growth estimate, I would say. But you've got this demand growth estimate, all of which in the past 10 years have been incorrect. We're still very much growing and growing till 2030, which it's very hard to know what the world's going to look like at 2030. And then you've got this. You've got supply coming down. Why? Because it's very expensive to invest in oil production. And you need to invest in it just to keep your production in line, flat. So I think there's in these oil producing stocks, a lot of this like short-termism, this like, ultimatum, finalization, black and white thinking, this idea that you're just going to get rid of oil and you can't, it's therefore a bad business. You don't know what the 20-year outlook of NVIDIA is. You might think you do, but you don't know. What if an Intel comes around and their profit margins go from 67 to 30? Now, that's obviously not going to happen in the next 5 years. What if Tesla? Elon just said on that investor call that they are going to have B200 class chips in their cars, that NVIDIA doesn't have chips that can help them. So, who knows what's going to happen? Who knows what's going to happen? You know what's going to happen with NVIDIA in 20 years. So enough with this BS, okay? Enough. This is JP Morgan, 2030. We don't know what's going to happen beyond 2030, but prices might go up, okay? Prices might go up. So if prices go up, what do you think happens to this? This is 2022, and this was with a larger share count, much larger share count. So you reduce the share count, you're going to get a lot of free cash flow per share. That's just the case. That's just what's going to happen. Now let's go to this final slide. Let's protect our downside. Roughly a week ago, there was a misread on OPEC, on what OPEC was doing. It was somehow interpreted that the fact that they're going to start bringing supply, they're going to start bringing supply online, maybe, depending on market conditions. That was the thing. Depending on market conditions, the market may be able to pull some barrels out of them that they took off. If the price is good enough, they might allow the market to pull some barrels out of them. Either way, they're filling up the SPR when the market's trying to push it around 75, when they're getting close to 70. So, we've been flat in the price of oil pretty much, and we've been staying around this 10% free cash flow. So I'm liking this stock. This is what I'm doing. I don't know what the price of oil is going to do day to day, month to month, week to week, whatever, quarter to quarter even. But longer term, I think these stocks are mispriced, and I am very comfortable owning this. This is what I own, okay? This is what you own too. Now, you expect that this absolute number, not the free cash flow yield, but the number it represents is going to go up. The free cash flow per share is going to go up. So let's see what happens. I think this free cash flow is going to go up. And if it doesn't, if it stays flat, this is still a good number to sit back and collect. So that's how I'm looking at things. That's where things stand in my thinking. I know this was very broad, very rough, but we covered big topics, big encapsulating topics of investing here. And I'm just kind of showing you opposite ends of the spectrum and why we're on this end of the spectrum. This side has uncertainty, particularly this, okay? It's not impossible. Yes, obviously there's uncertainty here, but at least here you're priced for that. So that is today's video. Until next time, peace out.